All right, welcome back to another deep dive explainer. As an investigative equity researcher, my goal today is super simple. We're stripping away all the media hype, the noise, and those flashy headlines to uncover Biogen's true intrinsic value. We're putting their Q2 2026 data on the operating table and performing a complete, unfiltered financial autopsy. Let's get right into it. First, let's knock out the mandatory compliance. Disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. Okay, bottom line, this is objective, data-driven analysis, not financial advice. Here's our game plan for today's explainer. First, we'll establish a baseline with the Q2 numbers. Then we'll run the stock through a rigorous 21-model valuation gauntlet, uncover 14 hidden flags the media's totally ignoring, run a reality check using the frameworks of legendary investors, and finally deliver our ultimate synthesis. Step 1. The Q2 baseline. Let's establish the foundational facts from Biogen's recent 10Q before we dive into the heavy math. Okay, so right off the bat, what's really fascinating here is the massive divergence in the earnings numbers. Total revenue beat expectations, hitting $2.74 billion, up over 3%. But look at that bottom line. We have a non-GAAP EPS of $3.60, which looks amazing, right? But then you look at the GAAP EPS, and it's just 66 cents. That is an 85% drop in GAAP net income year over year. Why the huge gap? Well, it comes down to heavy integration costs and a massive $3 billion cash outlay for the Apellis acquisition. You really have to look past those adjusted numbers to see the actual cash moving out the door. Moving on to Section 2. This is the ultimate valuation gauntlet. We're taking all this noise and filtering it through cold, hard, quantitative modeling across 21 different models to find the intrinsic value floor. Let's start with Group A, our cash flow and discounted models. Looking at our standard WACC, DCF, and unlevered free cash flow, the numbers are pretty wild. Biogen generated $408 million in free cash flow just in Q2 alone. That gives us a really strong 13% free cash flow yield based on their current market cap. Now, if we pivot to Group B, the dividend and income models, like your standard dividend discount model or the Gordon growth model, they literally yield exactly $0. Why? Simple. Biogen doesn't pay a dividend, making those specific models basically useless for us here. But honestly, that 13% FCF yield proves they've got massive underlying cash generation, even with those heavy acquisition integration costs weighing them down. Next up, Group C, comparables and multiples. The trailing PE looks aggressively expensive at 37.2. You are paying a huge premium on their current earnings. But if you look at the enterprise value to EBITDA, which actually accounts for their debt, it sits at a much more reasonable 11.16 times. In Group D, our asset-based modeling, we look at book value and net asset value. The book value per share is $127.61, which creates a very tangible baseline floor. With the stock trading where it is, the price to book is roughly 1.65. So this tells us the core assets are trading at a relatively modest premium to the actual equity. But here's the thing. For a biotech company, standard cash flow models miss a huge piece of the puzzle, the clinical pipeline. So for Group E, our advanced options, we have to use real options valuation. We're basically applying Black-Scholes logic to their R&D. Biogen has 5 late-stage clinical data readouts coming up in the next year across lupus and AMR. Think of these as massive call options on their future cash flows. When you add the real options value of this pipeline, it drastically bridges the gap between their tangible book value and their current market price. All right, Section 3, the media blackout. Let's talk about the hidden flags. Ignoring the surface-level revenue beats, let's dig into the footnotes, deferred taxes, and inventory accounting to uncover 7 deep red flags the media completely ignores because, frankly, they're way too complex for a quick soundbite. First, that GAAP net income dropping 84.6%. We're also seeing Vumerity revenue falling 7% due to really complex inventory dynamics. Then there's the Apellis debt. That's a $120 to $130 million annual interest expense anchor for 2026 and 2027. Net debt surged to $6.8 billion. Add to that the pausing of their BTK inhibitor due to market competition, a continuously declining legacy MS portfolio, and a 16% year-over-year drop in biosimilars. These are the slow bleeds and complex debt anchors you just won't hear about on mainstream financial TV. But hey, it's not all doom and gloom. That same media blackout hides some massive green flags too. For starters, their growth portfolio, sitting at $1.06 billion, has officially surpassed the legacy MS business for the second straight quarter. That's a massive strategic pivot finally paying off. Under the hood, Spinraza high-dose conversion is beating global expectations, and Leqembi just secured approval for at-home initiation. Financially, the Apellis integration promises $250 million in deferred run rate synergies by 2027. FY26 revenue guidance was just lifted to a mid-single-digit increase, and that gross profit margin, it's sitting at an incredibly robust 78.3%. All this is what drove that Q2 free cash flow up to $408 million, an amazing cash conversion metric that totally gets lost in the noise of the net income drop. Moving on to Section 4, it's time for the legendary investor's reality check. How would the greatest minds in finance value Biogen today? Let's start with Ben Graham, the father of value investing. If we calculate the Graham number and check it against his rules, Biogen totally fails. A trailing PE of 37.2 is just completely incompatible with his strict sub-15 threshold. What about Peter Lynch? We calculate the PEG ratio, price to earnings divided by growth, and it sits at 6.51. Biogen fails the Lynch fair value check too. The current growth rate simply does not justify that high of an earnings multiple if you're a growth at a reasonable price kind of investor. But Warren Buffett? Honestly, he might actually look twice. When you analyze Biogen's owner's earnings, which is net income plus depreciation minus maintenance capex, they really shine. That exceptional 13% free cash flow yield, paired with an ironclad 78% gross margin, are massive signals to a guy like Buffett. Even with the M&A debt, that level of cash generation strongly implies a durable, wide economic moat. All right, Section 5, the moat and our final synthesis. Let's pull all of this together. First up, paragraph 1, our valuation verdict. When we average out the gauntlet of all 21 models, Biogen is fairly valued at current prices. Yes, the PE multiple looks highly expensive on the surface, but it is heavily balanced out by that incredible free cash flow, a very reasonable EV to EBITDA ratio, and the massive, unpriced real option value hidden inside their late-stage clinical pipeline. Paragraph 2, the economic moat. Using Morningstar's 5 sources of a moat, Biogen's is wide and expanding over the next 3 years. It's sourced strictly from intangible assets, specifically their patents. And this moat is being actively bolstered right now by strategic M&A, like the Apellis transaction, and crucial first-to-market approvals like Leqembi for Alzheimer's. Finally, paragraph 3, the ultimate takeaway. Biogen has successfully crossed the chasm. They aren't just a declining MS company anymore. Their growth portfolio has permanently eclipsed their legacy business. They are a diversified, rare disease and neurology powerhouse today. However, you cannot ignore the $6.8 billion in net debt and those lingering M&A integration risks. They require absolutely flawless execution moving forward. So here's where we land at the crossroads. The models are pointing one way, but hidden flags suggest a storm. Which side are you on? Do your own homework. Thanks for joining me on this explainer, and I'll catch you on the next deep dive.